Welcome to another Killick Explains video, and this time I want to talk about 3 things most investors get wrong, and these are all mistakes that I've made in the past, so I am hoping that anyone watching this will not. Alright, now the bottom line is, what underpins this video is the idea that quite a lot of us don't make as much money from investing in particular as maybe we should. And there are several reasons for this, and I'm not going to hide behind any of them. One is we confuse saving and investing, and I'll come back to that in just a moment. Number 2 is we get fees wrong. Now, clearly you can pay too much to have your money managed for you, but sometimes you can also pay too little, believe it or not, and I'll come back to what I mean in a moment. And then there are just some classic behavioural errors, which I've covered elsewhere, but I'll recap a few of, which just mean we don't do some of the things that the professionals do, for example, that allow them to outperform the average retail investor, according to an awful lot of the data that I have access to. So, saving versus investing. Now, both are important, but the word saving is to some degree to me about managing cash, investing more about long-term wealth building through stocks and shares. And the point about cash, which I've made several times before, but it's always worth reiterating, is you do need some. We all need a rainy day fund. All right, and the amount, the number of months of your gross income that you keep to one side in the event of losing a job, for example, or a sudden cash call emergency is to a degree subjective, but you do need that fund set to one side. And then we need to provide for those foreseeable calls on capital, which is a grand way of saying those obligations and commitments we know that are coming up where we don't want to take the risk of not having the amount of money available that we previously thought. So we maybe want to be in something like bonds, IOUs, rather than pure equities. But once you've basically got those pots organised, then, as I said before, making decent long-term returns is about taking a little bit of risk by investing in, for example, the stock market. All right. So making sure that you're not over-saving and under-investing, if you want to see it that way, is critical. Now for fees. Now, obviously, you should make sure you're not being overcharged for financial advice, for having your money managed for you. But in this life, you also get nothing for nothing, if you like. So what am I saying? Am I implying that you should be paying more? No, not necessarily, but I'm just saying that, yes, by all means, automate some basic investing. If all you're doing is saving on a monthly basis, a regular sum into the stock market, then a very simple, palm of your hand, app-based, automated, regular savings approach could be absolutely fine and should be relatively low cost. But automation can't solve everything. There are financial decisions in life where robots, as far as I'm concerned, just don't cut it. Now, AI enthusiasts will say you're wrong. Well, that's fine. It takes 2 to make a market. All the way through life, we need to be making judgments, right? And these are much more difficult to automate. What you need to do changes with the age you are and the stage of life you're at. Pivot points include leaving home, getting married, for example, or at least taking on a partner, okay? Building a career, all right? Having kids, if that's something that you want to do or you have done, trying to get to a point where you don't need to work 5 days a week, looking after yourself in old age, all right? And these are nuanced, and your lifetime strategy needs to change as you move through these different stages. Then there's the passive-active debate. It's just not the case that passive is brilliant in all situations. By passive, I mean investment strategies where you just take an ETF, switch that on and off you go. It's also not the case that active management is better in all situations. Those are polar positions. The reality is, and I've covered this in more detail elsewhere, there are situations where one can be better than the other. I defy anyone really to get a decent exposure to the Indian market without a little bit of active help. But frankly, if all you're doing is tracking the FTSE 100 or the S&P 500, there's no need necessarily to pay for active management. All right, and then there's judging, when you're moving away from pure investing into wealth management. All right, if all you're doing is saving monthly towards the cost of a property deposit, then there's not much wealth management and planning to be done. When it comes to building a fund for life after work, that's a little bit more complex. Or drawing down on a pot that you've built to make sure it doesn't run out too quickly. That is quite hard to achieve through a pure app. Finally, mistakes. And there are lots. A classic, so let's just do a few of them, is confusing luck and skill. Now, I mentioned Sarah Beanie at this point. She used to run a property program, some of you may remember it, where basically people would do up a property and at the end of the program she'd say, let's see how much money you've made. And she used to make a very good point, and people didn't like this point very much. You'd have people in a rising market, a rising property market, who would have spent a lot of time and effort refurbishing a property to their specification, and then basically what she'd say is, you have to bear in mind, you've done a good job, you've made some money, the property's gone up in value, but I have to tell you, if you'd just taken the keys at the beginning, done nothing, and then sold the property and handed them over to someone else, you'd have made 3/4 of the amount you made. Why? Because the market was going up anyway. All right? And that's my point. You get investors in a bull market who go, look at me, look how I'm doing. And they forget that everyone's doing all right. Because it's a bull market, you've got to be something of an idiot not to. And they confuse luck and skill. All right? So that's just something worth bearing in mind. People think they've got an edge. All right? They hit upon a stock that does well once and they think, aha, amazing. I am a bit of a skillful investor. I'm a bit of a mover and shaker in the market. You're not. Okay? You're up against too many professionals, too many apps, too many robots. All right? So almost no retail investors and not many professional ones truly have an edge. All right? So sort of drop that idea. And people don't diversify. All right? Confusing luck and skill, thinking you've got an edge, leads people to narrowly invest. All right? They think, I've identified an idea that no one else has spotted. That's highly unlikely in most parts of the stock market. It's not impossible, it's highly unlikely. So diversification is absolutely key. Now, education. Where can you find out more about all of this stuff, and how basically can you try and eliminate some of the problems I identified? Well, there are my how-to guides. There's one sitting here. That will be editor@killick.com. There are Killick Explains videos, a bit like this one. That will be killick.com/learn. Some of those are in the new website. Basically what you're aiming to do is to break down jargon and boost your confidence with one caveat. And that is, a little bit of knowledge can be dangerous. People sometimes say, if I read these, Tim, can I DIY invest? I personally think not, but what you can do is approach investing, approach a conversation with a lot more confidence. You can save a lot of time, all right, and you won't feel quite as intimidated by talking through some of the important issues that I've hinted at in this video. So there you have it. Just a reminder, editor@killick.com for the guides, for a copy of Confidant, killick.com/learn for other videos.